Hi everyone, today I want to talk to you about the difference between passive and active investing. Now, the passive versus active debate is about just as polarizing as it comes to when people discuss what phone they use, whether it's Apple or Android, iOS. When it comes to investing, you normally firmly in one field and very rarely dabble in both. So before we get started, I think it's important for full disclosure that I actually prefer active investment, but I will do my best to be impartial when talking about the pros and cons of each. We will start with passive investing. These funds are commonly referred to as index funds and hold a group of stocks that make up particular indices. For example, you could just hold Vanguard's VAS, which holds companies in the ASX 200 and is just tracking that index. It is important, however, to know that it doesn't hold all 200 companies. Instead, it just holds enough to deliver an index-like return. This also means that it won't exactly follow the index, but it'll be near enough. An advantage of an index fund, though, is there is an absolute heap to choose from, and they're becoming more and more sector specific. So like in a previous video, I showed an index fund that just tracks companies that invest heavily in the esports arena. Here it is now. And you can see that it holds chip manufacturers, NVIDIA and AMD, along with a host of game publishers and creators. If you think global cybersecurity is going to be an issue moving forward, you could invest in Hack. Basically, what I'm trying to say is if you can think of a sector, there'll be an index fund for you to invest in. And another advantage of having an index fund is its low management fee, as they're not actively trading positions and instead hold the companies indefinitely, only reweighting in line with the index movement. So to quickly recap, the advantages of holding a passive investment, they are low cost. There is a lot of choice, meaning you can be more specific about your holdings. However, the disadvantage is you only receive market performance as they are not actively trying to pick the best companies. This brings us to active investing. This is where we have active fund managers buying and selling in a bid to outperform the market. Contrary to popular belief, though, is they don't trade on a daily basis. Instead, they usually buy and hold their best ideas and only sell at points where they are seemingly overvalued. Where with passive investments, you align your investing with certain market segments. With active investing, you don't really dive into that detail. Instead, you focus on a market, whether it be Australia or overseas, and if you want large or small companies. And finally, one of the biggest differences between active and passive investing is if you want to invest for value or growth stocks. So for comparison, we have Hyperion's Australian Growth Companies Fund, which focus on companies that are market leaders and continuing to capture market share, and Schroders Australian Equity Fund, which focus on well-priced companies with strong balance sheets. You can see coming out of COVID, we saw growth companies absolutely fly. We saw Afterpay go from $8 in March to $150 in February, along with NextDC doubling as companies required cloud storage for remote access solutions. But I guess what we really want to know is, where did Vanguard's VAS land in all of this? Well, let me show you. Pretty interesting, isn't it? Another thing to consider with active investing is the cost. We saw Vanguard's VAS only cost 10 basis points, whereas Hyperion will set you back 95 points and Schroder will cost you 62. So with active investing, there is always the risk you might pay a premium for underperformance. Now, there is so much more we could discuss in regards to this topic. So if you'd like to know more, please feel free to get in touch. And if you would like help building your own investment portfolio, make sure you book in for a complimentary meeting. Thank you.